I hope you enjoyed part 1 of my accumulation and distribution video, and in this video we're going to continue our previous discussion. We're going to go into a little bit more advanced concepts, and I've prepared more chart studies, more trade studies to help you understand different kinds of chart contexts. So the next example is called resistance shifting. Other traders will refer to it as fake outs. There are many different ways, so let's take a look at how it looks on our charts, and then it will make a lot of more sense. A lot of traders are always complaining that support and resistance doesn't work, it's too simple, it's a retail concept for whatever this even means. And this is really helping you to understand that support and resistance is actually working, but the way you are doing it and most traders are doing it is probably not the most effective way. So let's take a look at what we are seeing here. We have a market rolling over from uptrend to a downtrend, very clear, well-connected distribution zone. We have support, we have here the highest point, and we have drawn the zone here. So when we go forward, you can see the market is coming back into the zone. You can see that it's dipping into it. We have a very nice pattern here that we could have used for a breakout entry. So this is our highest point now. You can see the market has dipped into the accumulation zone. And what are we going to do with this? Are we going to wait for the market to come back to this? And what are we going to do when the market gets back to the distribution zone the next time? And in the previous video, I've shown you an example where the market breaks through a distribution zone or accumulation and completely reverses. However, there's another thing that can often happen. And what you will often see is that you have fake outs. So the market is, here is the first example, the market is coming back into it very nicely, precisely reacting to it. And a lot of traders are probably going to get into a breakout here again because they think, oh, there's amazing resistance to the pip and this cannot fail. However, shortly after, the market is back above the level and a lot of traders either have now their stop loss hit or they're sitting on a losing trade and are very frustrated. And this is a fake out concept that you will often see. So what happens is that the market is immediately reversing back below and it is immediately falling back into the zone. So sometimes the market will go higher and higher and higher and you can do nothing. So if the zone or if the trade idea doesn't work out, just get out. However, if the market reverses back outside of the distribution zone and continues lower, this is what traders refer to as a fake out. So you are, or some traders will refer to as a trap, bull trap, bear traps. You can find those terms on YouTube a lot. And you can see the market is falling back into the zone. And at this point, it is a clear fake out. There is often still a lot of interest left. So as long as the market hasn't completely pushed through a accumulation zone, I would still always keep this on my charts and wait for the market to react to it. And you will often see that the next pushes or the next time the market comes back to such a zone, it's pushing into the zone deeper and deeper and deeper. Because a lot of traders are waiting for the market to react to the specific previous price point because that's what general support and resistance theory is teaching them. However, in reality, price is messy. And the professional, the big players, the smart money, whatever you want to call it, they are obviously aware of how the average retail trader is trading. So what is often seen is that they are manipulating the price. Some traders believe that their broker is hunting their stops, which is typically not the case. What happens is that it is just general theory. Everybody knows that a lot of retail traders will get into previous support and resistance touches, and then the smart money drives it through it and immediately reverses it to just free up some liquidity. And you can use this as the basis of your trading strategy. For example, what you could be doing, as soon as the market drops out of the zone, you could go to a lower time frame, look for continuations to the downside, or on that time frame, wait for the market to get out of this accumulation or distribution zone, which has now formed. And you can see this has happened afterwards. And then the market, here this is the last example, the market comes back into the level. It looks like the market is going to make a very precise reaction at first. You can see the candles here, they stop really precisely at the level here. And then suddenly there's a spike that is shooting for those stops, stop hunting, fake outs, traps, whatever you want to call it. This is what is happening here. And the market is immediately back below the support. So what happens afterwards? Now you have the real fake out. The market is pushing through it and reversing. Of course, sometimes you will not be able to protect yourself from it. Sometimes you will just have to face a loss. However, if you see that, for example, you may have gotten into this and then you've been out with a stop loss hit somewhere around here probably, If you see that the market is coming back lower, this is your clue that this is actually not a breakout to the upside, but it's a potential fake out and a trap signal. So even if you take a loss, shake it off, regain your confidence, make sure that you have your clear mind and that you are ready for the next signal. And the next signal could then be your turnaround. And this is what happened here. You can see we have the deep push, the market broke through it, dirty retest, sold off. And then the next time it happens again, it seems like it. The market is pushing through it, it's pushing through this resistance level, making a higher high, giving you here this nice distribution level, and potentially we're looking at a reversal again. So the takeaway of this is that it is important to be aware of support and resistance, distribution, accumulation. However, trading is very dynamic. The price that we see on our charts is very dynamic. And there's a constant battle going on behind the scenes between the bulls and the bears. And this dynamic support and resistance shifting with those traps and fake outs and the bull traps is something that you need to be really aware of, because I see many traders that have problems trading support and resistance because they're too locked in. And if you open your eyes to those concepts of fake outs, fake breakouts, reversals, support and resistance shifting, then you will be able to use those concepts much more effectively in your trading. Let's take a look at accumulation and distribution fractals. And I love this concept because it really helps us understand that time frames are not really important as long as we understand the concepts on our charts. And then we can apply it, whether it's the 1 minute, whether it's the 5 minute, the 1 hour, the daily, the weekly, the monthly. The patterns are repeating themselves all over again. And this is the beauty of financial markets. So what do we see? We have our common pattern, and after a while you will start noticing those patterns on your charts as well, because they're just so common. It's what drives the market and trends. We are going from an uptrend to then a sideways range, a breakout, and to a downtrend. And at the top, it's a distribution. Very often, for example, you could add an MACD, an RSI, a stochastic, any momentum indicator, and you will get a divergence here. And very often, a divergence is followed by a sideways range. And then if you get the breakout and a new trend, then you're looking at a distribution. Again, distribution, accumulation are only observable after the fact, but that's totally fine. We want to know when an uptrend is shifting towards a downtrend, and then something must have happened here where the market, and this is the Euro-British pound, a huge, widely traded Forex pair. So something must have happened here that really led the buyers to leave the market was high enough, the price was high enough, and then the sellers took over. So something in here has happened. And the same thing happened then here at the downside. We leave the accumulation or the distribution zone, we go lower, we turn around, we are having first of all a divergence here, then a double bottom and a breakout. So we are on the 4-hour chart here, right? We have the distribution and we have the accumulation. We are dropping to the 1 hour and we're going to go to this zone here, and we're going to look when the market is coming back into distribution area. So let's zoom in a little bit. First of all, if you want to learn more about this is called a void. In Forex, we don't have gaps typically other than the weekend, but this is the closest thing that we are getting to in Forex to having a gap. So what happens here, that there was only buying interest, nobody wanted to sell, and the market just basically gapped higher immediately within just a few candles. And by the way, this is a very interesting concept. If you want to learn more about this, leave a comment below. And I will consider making a special video about those gaps, voids, whatever you want to call it. There are a few names for them. And then you can see we have our divergence here. The market is rolling over and it's breaking out of the pattern. And then we are looking here at this zone. What do we have here now? You can see the market is coming back into the zone. This is called a liquidity pullback, a support and resistance pullback. And if we go to the lower time frame, we are now having here a pattern. So we can very nicely define this pattern using a trend line. So what are we going to do now as a trading plan? We wait for a breakout, we wait for a break and retest. Breakout happened. We could also add a pivot point. Central pivot point rejections are very important. In an uptrend, you will generally see that the market is trading above central pivot points. And in a downtrend, you will often see markets reject central pivot points, especially if it happens in such a nice context. We have our break and retest pattern. We have wave 1, wave 2. We're looking at potential continuation wave 3. We have a pattern breakout here. We have the central pivot point rejection right into where other people have their break-even stops. Another very important concept that those rejections and those spikes often have is a lot of traders will go short here. Their stop loss will be here. As the market moves in their favor, they will move their stop loss to break even. And those spikes here, those retests, are really only looking for those break even stops, and then often have a very strong reversal. So you can see a lot of interesting things are coming together. We are dipping back into the distribution zone that we have identified on the higher time frame. We are looking for a wave 3 continuation after the break and retest. We have the central pivot point rejection, and then off we go. So you can very nicely see how you can use that in a multi-time frame context, using the different confluence factors in your that you can use to create a more robust strategy. You can see afterwards, after the market has rolled over the central pivot points, rejected it, then you can see we traded below the central pivot points. It gave you a lot of confluence and confidence in the downtrend. And that's how you can really start building a trading strategy, using those zones at the base and then layer Elliott wave, breakout patterns and other concepts on top of it to create a more robust approach.